We're talking about things you do at the end of an audit to sort of wrap things up. One thing you do at the end of the audit is get written representations from the client's management. So you want the CEO and CFO to sign a statement where they're saying basically, these are the financial statements, we have read them and we promise they're correct as far as we know. We've told you everything, we haven't hidden anything. Just sort of making sure that they've provided you with everything. We haven't held anything back. You're just sort of making sure that they know that they're responsible for the financial statements. They're saying, we understand that it's on us to prepare them correctly. You're just the auditor, right? And that way, if something comes up, you can say, look, they told us that they were hiding something, and you can say, nope, we made them promise, they told us everything. And if a client won't sign the representation letter, that's a person you do not want to do business with. You'll have to qualify or disclaim, which we'll get to what those are in the next chapter, disclaimers and things like that. So what's in them? Well, there's usually a paragraph that says that management's responsible for the financial statements, that they have disclosed everything, and that everything is presented in the proper accounts and classified and reasonable. If there are misstatements, they're not material. We've provided all the information that the auditors need. We haven't withheld stuff. And we're responsible for internal controls, right? We've made the things. And then here's just an example letter. And you can see it's just, it's provided to the auditors, and it just states, we understand this and we say this. You can look at that in your book if you want. Ability to continue as a going concern. So, this idea that we're auditing a going concern is important, because think about it. If this client of yours was about to go bankrupt, the accounting would be different. Assets would be more of a liquidation value. Long-term debt would be accelerated and become current debt. So equity would be not worth anything, right? So it makes a big difference if this is not a going concern, right? That's one of the GAAP assumptions, right? All those assumptions we make, monetary unit, going concern. This is important because the financial statements would be presented very differently if it was not a going concern. So, and of course, people would think of that organization differently. Now, just because something's not a going concern doesn't mean the financial statements are misstated, right? But you as an auditor, so in other words, the financial statements could be fine, it's just that they're going broke, right? So you as an auditor have to look at the financials once you're done, right? You've audited them, you know that they're fairly presented. Well, is this a going concern? Like, are they going to have to meet more debts than they can pay for with their cash? Are they going to have to liquidate some assets? Then that way they won't have the same operations in the future and can't make this, right? So you have to think about, like, almost as if you were an investor. Is this company going to be here? Or is it likely within the next year they could be bankrupt? And if you think they could be bankrupt in the next year, you have to say, we have a concern, we believe this is not a going concern, that they could very well be bankrupt. Now, before you put that in an audit report, you go to management and you say, hey, look, your working capital is not going to cover what you need to do next year. You have these debts. And then management is going to give you there's a lot of back and forth at the end of an audit. And management will say, we've arranged this line of credit. We're going to do this and this and this. And so you have to decide, oh, okay, that makes sense. This is a going concern. But if you really think it's not a going concern, you're going to have to modify your audit report. And we'll learn about that in the next chapter when we talk about reporting. Adjusting entries and financial statement disclosure. So here's the deal. At the end of the audit, you're going to find some stuff that needs some adjusting entries. You're just going to find something like, oh, this is not right. You should fix this. So you'll have like a list of just things they should fix, right? Here's the entries, all right? And you're going to have to decide if these entries are material or not, right? Because as the auditor, when you do your report, you're saying these financial statements are fairly presented in all material respects. So, in other words, if there are some immaterial misstatements, that's okay, right? So you're going to go to your client and say, here's all the misstatements. And the client says, well, that's great, I'm not fixing them. And if they're not material, that's fine. You don't care. You only care about material misstatements. They don't have to fix immaterial misstatements. Now, here's the issue. You're obviously recommending everything. Now, suppose they have some uncorrected misstatements. Okay, that's fine. They're not material. I'll still give you unqualified opinion. But now you've got another year. Suppose this carries on, right? So you have to make sure that from year to year, misstatements aren't going to become material, right? In other words, they can aggregate, right? And then they could become material next year. So when you do your next year, so you have to look back across the years and see, is there any way any of this has become material? And at any rate, when you find misstatements, you communicate that with the audit committee because they need to know what's misstated. That's big part of your job. Now, of course, at the end of the audit, once you're done, before the audit report goes out, it's going to get reviewed, right? So the audit supervisor is making sure that all the auditors out there doing their work, all the steps have been performed, everything's clear, right? They read through it, make sure it's a good report. Then there's an audit partner. So the main person at the audit, the partner from the audit firm who's in charge of it, not the manager who's on site, but the audit partner who is the business relationship person. They're still responsible for the overall audit, right? So did we get everything? Do the conclusions? They're not going to read every detail, but they're going to say, here's the conclusions. Does it support the opinion? Then there is going to be a separate reviewing partner. So there's going to be an audit partner from the firm who hasn't worked on that audit at all. That's not their client, but they're a partner level person. And they're going to review that work and say, okay, am I okay with this audit? Does it meet the standards of my firm? You know, my firm's name is going to go on this. Am I okay with this? Is it good? It's like a quality review. So you've got, of course, the manager, the day-to-day audit manager reviews everything and is making sure it's all good. The partner reviews it. The audit partner for that client reviews it. And then a separate partner not related to the audit at all, but is an auditor, is audit partner, they're going to review it too. So you have a big review. Right, make sure. All right. And so then you're done, right? You've got that date, the completion date, and you're done. We're not going to look. We're done with this audit. It's been reviewed. We're fine. We're going to issue it. All right? So, before you issue it, right, you're just going to make sure that there aren't any subsequent events or subsequently discovered facts. So these are two different things. All right. A subsequent event is something that happened after the financial statement dates, So it didn't happen during, but it kind of has an impact. So you can imagine, our inventory on December 31st is $10 million. On January 5th, the warehouse burned down and it wasn't insured, and so now we have inventory that's only $5 million. Right? So the financial statements are true. On December 31st, they had $10 million worth of inventory, but a subsequent event happened, and we need to note that, right? So that's a subsequent event, something that happened after. A subsequently discovered fact, right, is something that changes the financial statements, all right? So in other words, I did my audit, I'm all done, or I thought I was all done, and then I go back and I find out, oh my gosh, on the last day of, so it's like in January or February, on the last day of the year, their biggest customer declared bankruptcy, and now they're not going to get paid $5 million on that account receivable. That's material, right? So, yes, it happened during the financial statement period. You didn't find that out until later. That's a subsequently discovered fact, right? So that's the difference. A subsequent event happens after the financial statements are done. A subsequently discovered fact is something that happened back when you were doing your audit. You just didn't find it out until subsequently. Okay, so you have to check for that stuff. And either if it's a subsequently discovered fact and it's material, they're going to have to go back, and it's something that should have been in the financial statements. Your client has to go back and fix that if it's material. If it's a subsequently discovered, if it's a subsequent event, in other words, a warehouse burned down in February, well, you would put that in the notes. You would disclose that happened in the financial statements, but doesn't affect the numbers. And actually, even after the report is out there in the world, right? You would think, well, at some point my duty ends, right? I mean, I've audited it, I've released a report. Well, if you have a subsequently discovered fact, right now, not for events, but for subsequently discovered fact, in other words, there's a misstatement on the financial statements. And this happens because typically auditors audit the next year too, right? So I finished my audit for 2017, and now in like February, March, April of 2018, I'm doing the audit for 2018. I'm doing some cycle counts, stuff like that. And I find out, oh my goodness, this stuff is obsolete. It got counted last year. It was obsolete last year too, right? So, something like that. So you tell your client, hey, you're going to have to restate your financial statements. Inventory's overstated due to this obsolete stuff. And it was obsolete last year too. So they would have to restate the finance. So you let them know if you find something out. And if they don't, then you have to notify people. And that can happen because remember, you're hopefully continuing to audit them year after year. And you're going to find some, oh my goodness, on that last audit, we missed that. All right, so how do you identify subsequent events? Well, you ask management, you ask them what's going on, you read minutes of board of directors meetings, right? So we're talking about like after the financial statement date. So like, what are they talking about afterwards? Oh my goodness, this has happened. We're going to have to file an insurance claim. Right? You're finding out, oh my gosh, what happened? Reviewing their interim statement. Remember, we're talking, if the financial statements close December 31st, as an auditor, you're still working January, February, maybe even the first part of March. Well, by the end of March, they're going to have their first quarter statements ready. So those are interim statements. You can look at those. They'll tell you stuff. Types of subsequent events. Subsequent events provide new information about conditions. You may need to adjust the financial statements, or if they came up after, just disclose them. Subsequently discovered facts are something that you discovered that pertain to the period under audit. So if you can find this out before you release it, you just revise your audit, fix everything, and maybe put a new date on that one part. If the audit's out there, you have to notify people if your client refuses to change it. All right. So when we come back, we'll talk about a few more procedures.